Let's quickly have a look at what... I want to start with just the US inflation print because it's absolutely key for every single asset class. Could we see a big surprise to the downside? And that actually also brings us to the question of the day, which is how will assets perform after US inflation? Now, the thing is, Tim, what are you looking at? Could you see a surprise to the downside? And if so, what will happen?
So I will ask question, and obviously there's a potential for a downside. And our view is that U.S. inflation probably has peaked and will start to come off for many of the reasons that were just discussed. That there are some transitory factors that oil prices and broadly, particularly at the pump for the U.S. consumer, have come down, et cetera. But the real sticky bit of inflation is, of course, in the labor market, and that's where there's some progress that's been made, but a lot more that has to be accomplished. One of the issues or the indicators that we look at is the gap between job openings and the labor force, this sort of labor wage gap, and job openings gap. That's coming down, and that's actually the key to a soft landing. That if the gap comes down, but you don't have to have a corresponding significant rise in unemployment, that's kind of the narrow path to a soft landing, which is what our U.S. economists are broadly expecting. But the key point to make here is that if the market gets happy about an optically better inflation print and starts to rally, that's going to mean that financial conditions ease, which means that the burden on the Fed remains that much more significant. So there's a sort of negative feedback loop between the market feeling good about the future and the Fed needing to persist and maintain higher rates for longer in order to really guide the economy into that soft landing. So our bottom line is that we think the market's correct in pricing in 75 basis points for next week's hike. We then think there'll be another 50, another 25 in the November and December meetings respectively. But the key difference between our views and the market is really next year, that we think that we'll get to about a 4% Fed funds level, but we're going to stay there next year, whereas the market is still pricing in some easing next year, albeit less than before. And that we think is still on the optimistic side, and is why we think that equity markets will still need to have a bit of work to do before we really square the circle between high and persistent inflation and the work the Fed needs to do in order to get it down.
So, Tim, let's get to what's been happening in this part of the world. And I think that this is your latest paper that you've been writing about and talking about Asia-Pacific equities having a decade of underperformance. Give us a sense of why that is the case and whether there's a turnaround in prospect anytime soon.
So the bottom line is we think there are reasons to be moderately more constructive. And what we've done in this paper, which is quite detailed, and obviously we don't have time to go into all the details of it here, is to note that there was very clearly a decade of underperformance of Asia versus developed markets, most significantly against the U.S. When you look at the numbers, it's really because earnings delivery fell short in the last decade compared to the 1 or 2 decades before that, the 1990s and the noughties, when earnings growth on a compound basis was between 12 and 14%, and that dropped down to about 7% in the last decade. And it's even worse than that because most years are actually 4% EPS growth or below, with just two exceptional years in the course of an entire decade. The reasons for that, super quick, are that the positive boost from trade that really was very prevalent, especially for China in the early 2000s when China joined the WTO, that basically we kind of got through that, and the contribution from trade diminished. Interest rates fell, which really hurt the financial sector, which is about 30% of earnings. Commodity prices fell, which sort of lowered overall nominal GDP, and which tends to have a positive correlation with earnings growth. And I think very importantly, the impact of technology disruption, or of that sort of rapid technology change, which was so powerful and positive for the U.S. market, was much more of a headwind for Asian companies who were more price takers than price setters, and required a great deal of adjustment on the part of those Asian corporates. Looking forward, we think that there's been some adaptive response by Asian companies, and also there's been some index compositional shift, which has taken place. And in addition, we see the interest rate cycle having changed, which is more now of a tailwind for the important banking sector. So if you roll all that together, we think that on a forward kind of trended basis, that we'll be able to grow perhaps at maybe 10% over the next 5 years compared to the 7% compound rate that we saw in the past decade. And given the fact that markets have corrected so much, and a lot of the sort of the excess of the previous bull market has been eradicated, that probably sets the stage for somewhat better performance, both fundamentally and in price terms, on a trended basis. That's basically the construct of the paper we've done.
Yeah, 37 pages, Tim. You and your team, of course. Right, back to the, I guess here now, short term. MSCI Asia ex Japan, negative 2.2% is the consensus full year EPS estimate. Do you still think that's optimistic?
Okay, so for the MSCI Asia Pacific ex Japan index, we're looking this year at 7% growth overall. Consensus on our numbers, this is good as of Friday's close, is 9%. So I'm not quite sure where the number that you just quoted is emanating from, but looking at the bottom-up numbers, which we look at in pretty robust and considerable detail, those are the numbers. The delta is that in the past 2 months, since the beginning of the third quarter, there's been about a 2% decline in the consensus 2022 estimate, significantly focused on the negative side in Hong Kong and Australia, and actually on the positive side, we've seen some upgrades in ASEAN. China in particular is where we've got the biggest variance in our numbers versus consensus. We're at 0 for this year for China. Consensus just most recently was at about 7 or 8%. That's not come down to about 5 or 6%. But we still think there's further downside for reasons that Enda and was just mentioning before this particular conversation, which is that you've got the drag from COVID, you've got some less of a forceful contribution from trade, and of course you've got these zero COVID lockdowns. So and the property market having come under pressure. So you've got a number of sort of near-term issues which you don't think consensus is fully reflected in their numbers.
Yeah. Tim, maybe just to clarify too, I think that's a top-down number which we mentioned earlier. I mean, we can bump our heads on the data, I mean, at some point. Last question for you. Indonesia outperformance this year, does that continue or do you start fading that outperformance? What are your expectations there on that market?
It's a great question. We've actually been asking that ourselves. We went overweight Indonesia last year when we upgraded ASEAN for the first time in a decade. Late last year, and we're overweight Indonesia and Singapore. Very happy that Indonesia is the top performing market this year. And you always kind of wonder, at what point do you kind of edge the sidelines and book your gains? We still think that the investment case for Indonesia is still pretty good. Earnings growth is still going to be in the mid-teens. The market is not trading at inflated valuations. We still very much like the banks, which are a significant and prominent part of the index. There are a couple of near-term issues. Obviously, this repricing of domestic fuel prices, which will have some flow through to inflation, and obviously that's causing Bank Negara Indonesia to raise rates, but those are all well within our expectations. So I think we're content to stick with the constructive view for a while longer until the prospects for some other parts of Asia, which have been under pressure, notably Korea, Taiwan, look a little bit better. But we don't think we're quite there yet, so for the time being, we'll stick with our constructive view on Indonesia.